Hi guys, Tim Melvin coming to you. It's Tuesday once again. I meant to get a video out over the weekend, but we had baseball games and granddaughters and a bunch of other fun stuff going on, so we just never quite got around to it. And I have no excuse for yesterday. Time just got away from me. I have to say, as I sit here, that the market rally that we've been seeing, we're off a little bit today, but just a little bit. The market rally we've been seeing has been nothing short of remarkable for the last 12 days. Stock prices have gone pretty much straight up. 10 of the 12 days have, in fact, been days where the market closed up. There's just a ton of institutional cash coming into the market, pushing stocks continually higher. Even the Russell 2000, that tired, old, exhausted index that has been trying to play catch up for, a couple of years now, has actually rallied about 7%. So the money just keeps coming in no matter what happens. It really is remarkable. We've got higher interest rates, something that doesn't play well with the market. 2 months ago, if you just said higher interest rates could possibly happen, we would have seen a sharp sell off. Now that they're happening, the market doesn't seem to care as much. Now, we will see if that changes when we start getting the 50 basis point cuts, because in spite of everything going on in Ukraine and around the world, Jerome Powell and the Fed have remained adamant that the number one mission right now is to put inflation back in the cage. Gonna be hard work. Inflation, by the way, is running amok all over the world right now. Germany's up over 8. Spain looks like it may hit 10%. This is going to be a global problem, and one that's very difficult to get under control. But when you look at this, the market just doesn't care. Bloomberg said that inflation is going to cost the average family in the United States an extra $5,200 for the average family. That's could be a huge chunk of the cash, excess cash left over after everything's paid for. So it's gonna be a game changer. Market really doesn't care. War continues to run amok in Ukraine. Every day I see something about how there were positive talks. And every day you go into Twitter and you see the feeds coming from Ukraine. And nobody there seems to be reporting any lessening in Russian efforts to capture territory in Ukraine. They may have backed off around the capital. I understand in the eastern and southern parts of Ukraine, the Russian troops are very aggressively bombing and using missiles and encircling these cities. So it's still a mess. It's still a war. We've adapted to it very quickly. Nobody's horrified anymore, and the market just doesn't care. It just keeps going higher. The yield curve is inverted. Ooh, that's scary stuff. That'll spook stocks. Not even a little bit. It's the first time the yield curve has inverted since 2019. It is quite often predictive of a recession. What's not quite so precise is the timing. That could be anywhere from weeks to months from now. And I've been saying all along that other indicators in the interest rate markets have been telling me for quite some time, good chance of a meaningful economic slowdown or even possibly a recession in the back end of 2023, because the Fed's going to have to really reach into its bag of tricks in order to get inflation under control. But the market really didn't care about that. Germany and France, they were running out of gas. Market doesn't care about that. It just doesn't care about anything. There's a flood of dollars coming into stocks right now, just going to push it higher for a while. No idea how long it's going to last. Maybe we've even seen the top. I'm going to keep my head down and just keep trying to find situations like small banks where I just don't have to spend a lot of time thinking about what the stock market may or may not do to me, because the stock market doesn't care. It's going to do what it's going to do. You would have thought with interest rates, inflation, war, everything that's going on in the world, that the market would have continued selling off. Had you bet it that way, you would have been wrong and lost a ton of money. So we're not going to do that. We don't play that game. We did just have our third takeover in our banking portfolio announced. So we're on pace now to, get back into double-digit takeovers in 2022. And that'll be nice to see that happening again. This latest one was Randolph Bank Corp. It's a small bank that did a thrift conversion offering several years ago, now eligible for takeover as the restrictions have expired. And it has, in fact, been taken over, and we made about 100% gain on that, holding it for just a couple of years. Look, buying high yield banks and buying banks, especially former thrifts that fit the profile of a likely takeover target, is just ridiculously profitable. You can make the kind of returns in your accounts that hedge fund managers dream about at night. You can make that a reality in your portfolio. So you might want to, if you're not already a subscriber of Banking on Profits, I really just highly recommend that you go ahead and jump in there, and you'll get the high yield bank portfolio, you'll get the targets portfolio, and I think you're going to make a lot of money with it. We've been out for about 8 years, and it's just been very successful. Lots of happy subscribers. Looking around, I've found a couple special situations I want to tell you guys about that I think can make us some money almost no matter what the market does. I can't guarantee that there'll be no volatility, but there is lots of reason for the stocks I'm about to give you to move higher over time. The first one is Sportsman's Warehouse. This is SPWH. This is a busted deal stock, guys. They had agreed to be acquired by Great Outdoors. That's the company that owns Bass Pro Shops. And Sportsman's Warehouse is a similar type of sporting goods retailers, all types of sports, hunting, fishing, all of that. It's going to be at an $18 a share offer. And unfortunately, it became obvious that the FTC was not going to allow this deal to go through. I want to get the current quote up here on the screen. I can quit messing up. Once that became obvious, they did cancel the deal, and Great Outdoors had to give Sportsman's Warehouse a $55 million breakup fee. They were pretty happy about that, as I'm sure you can imagine. There it is. Okay, so deal price was at 18. It's right now trading at 11.60. Sorry if I should have been ready with that, but I wasn't. Anyway, they're taking the $55 million. They're going to add 20 million from their cash flows because business is really good right now, guys, and expected to stay good for quite some time. They're going to add 20 million. They're going to do a $75 million stock buyback. That's a significant percentage of the company. That's going to provide some support for the stock. And again, you're way below the levels where they agreed to do a buyout. Management has shown that under the right circumstances, they would be open to a buyout. I got to tell you, if I was a private equity firm running a fund right now, I would be looking at this company sitting here with, great growth, further growth expected, exceeding analyst estimates, just coming off a record 2021, trading at, less than 7 times earnings. Okay. If I see that, I'm a private equity guy. The balance sheet's not all levered up here. I I think I'd be consider adding this to my portfolio because it's classic. You could use quite a bit of borrowed money to buy this thing and then just use the cash flows to pay down the debt, therefore creating a ton of value for the investors in your private equity fund. I don't run one. The symbol here is SPWH, Sportsman's Warehouse. I think that this does well pretty much no matter what happens in the market. Another takeover offer has to be a possibility here. Even if there's no takeover offer, the market for sporting goods, particularly hunting, fishing, ammunition, handguns, all that stuff has been on fire since the pandemic hit, and there's absolutely no sign that any of that is going to go away. So I expect great things from the company, which should be reflected in the stock price. Another buyout's not off the table by any stretch, I don't think. Then this next one, this is what, just buy this, okay? It's Versa Bank. It's not a high yield bank. VBNK is the symbol. I've talked about it before. The bank is a Canadian bank, and they do some really specialized niche lending. But the real story here is they're a digital bank, and they're going to do a VersaVault product that is for the storage and containment of digital assets that are on the blockchain, cryptocurrency, and just about anything else that could be on the blockchain. They bought a specialized U.S. cybersecurity company to provide security for their digital vault. It's going to be pretty big business. If this was an American bank, it would probably be trading at 2 or 3 times the rather paltry 11 price to earnings ratio it has now. There's not a lot of digital banks going on up in Canada. The niche lending that they're doing is very high margin. Um, so the bank is profitable. I expect to see very high rates of growth. This was like the quietest IPO ever last fall. I mean, you've got this great digital bank coming out. It's in Canada. They're doing an IPO. There was no buzz around it, no nothing. The stock hasn't done a whole lot. The insiders have been buying rather continuously since the offering. So this thing's just sitting here. It's going to have very high earnings growth. Once it gets recognized, picked up, followed a little bit more by the street, begins to build a stronger presence in that global market for digital assets. I think the bank's stock price is eventually going to shoot higher. Could happen sooner if some of the Reddit guys get a hold of it, but who knows if that'll happen or not. It's a real opportunity, trading at 11 times earnings. Comparable U.S. tech forward banks are trading at 20, 25, and even 30 times earnings. So I think this thing is dramatically undervalued at this price. Right now, this one I'm going to give you guys, this is just a good old-fashioned cock the bat back on your shoulder, lean all the way back, swing from the floor, looking for a home run. Don't buy a lot of this one, because if you buy a little bit, it's going to more than make you enough. This is want to keep this in the realm of, if I'm wrong, I lose a little bit. If I'm right, I make a lot. Okay. The stock is Williams Industries, WLMS. They are in the business of construction, maintenance, and support of utility and industrial plants and facilities. Primarily here, we're talking about utility plants. They're involved in all types: oil fueled, coal fueled, natural gas fueled, and even nuclear. In fact, nuclear decommissioning is a pretty big part of their business. Look, guys, if they come even close to hitting management's targets for next year, the stock's at least a double. Insiders love the long-term potential of this thing because they are just continually out there buying stock in the open marketplace. And that's all the top executives, including the CEO and CFO. It's like every week, sometimes it feels like almost every day, there is an insider at Williams Industries buying stock. You do not buy stock in the company that you own unless you believe great things are coming. Insiders do not buy for percentages. They buy for multiples. I think that's what you're looking at here. They also have a 10% shareholder, Winfield Capital, they've been known to be a little bit aggressive and activist in their approach to buying companies and owning for the long run. So they will give them a nudge to continue to do all the things that they need to do for this company to be successful, to regain its kind of mojo and get flying again. Now, the stock, it's like a $2 stock, guys. As I said, I think it can double or better just based on them hitting management's, what I think are rather conservative estimates. Nobody on Wall Street's paying any attention to this stock except a few institutions and the corporate insiders. Now, guys, I just want you to think about everything that's going to have to be done to the electrical grid. How many new plants and facilities are going to need to be built just to handle the electric car explosion that we're seeing. Now, I'm on record as saying the EV thing's not going to happen quite as quick as everybody thinks it is. And one of the reasons is we don't have enough electrical plants, okay? Going to have to expand the grid by about 25% at least. That's going to be messy politically and environmentally and take a while. But these guys are going to get more than their share of business. Eventually, somebody's going to wake up to the reality that you can't get to 100% green without involving nuclear energy. And with distributed nuclear energy using smaller power plants, now a very real thing, and something that's being used in some parts of Europe where the Greens haven't completely taken over and shot themselves in the foot. This company is going to see a lot of business over the next decade. There's going to be opportunities for them to grow their profits at a very high rate, use the cash flow to buy back stock, pay down debt, and do all those things that I love to see management doing with cash flows. I think you can get at least a double in this stock over the next year. However, but for patient, aggressive, long-term investors, again, I think there's a real opportunity at a 10-bagger here. And I don't think that this stock is going to be impacted very much at all by anything that the stock market does in the interim. It's way off the radar screen. Insider buying, institutional buying, supporting the stock price. Here's an opportunity. Buy a little bit. Maybe, just maybe, you hit a monster home run with the stock. So, guys, that is all I have for you so far this week. I'll say it again. I'll try to get back to you Friday or Saturday with another video, particularly if something really interesting happens. We have not yet talked about a high yield bank stock this week, so we still got to get around to that. So I'll try to get back in. You know what? It's not going to be this weekend. I just realized going up to the Orlando area to see granddaughter number 2. So it's going to be a very exciting, fun weekend. I love going up there and seeing my son and his fiance and the baby. And we might even take in SeaWorld if the weather holds up pretty well. So try to get to you Friday. If not, I'll sure be back Monday or Tuesday next week, and we'll get to that high yield bank stock. Anyway, guys, I'm Tim Melvin. Thanks for watching. Have a great rest of the week.